So we can really use some simple maths and say, okay, maybe mid-20s, that's when the shortages of fossil fuels really starts to hit. But then we get to the problem, can we actually generate enough replacement technology, so wind farms and solar panels, when this oil and gas sort of cliff starts to sort of hit the global energy market?
In June 2023, I hosted 6 interviews, which became known as the Net Zero Delusion series. At the time, the videos were for subscribers' eyes only. The basic idea was simple. The writing was already on the wall for net zero. The real question was how it would fail and how investors could position themselves to profit from this. These days, net zero is falling apart before our very eyes. Not a day goes by without news of all the different ways that it's failing. That means the investment ideas we presented in our series back in 2023 have now begun to play out. So, did our experts get their predictions right 2 years ago? We invite you to watch the Net Zero Delusion series for yourself to find out. Hello and welcome to the latest video in our series on net zero. If you want to know just how bad the metallic dissonance of net zero politicians is, you're going to have to ask a mining veteran. And so I did. James Cooper is a global mining exploration veteran with some additional experience in corporate finance. In 2023, he combined these skills and became the editor of 2 investment newsletters in Australia, Diggers and Drillers and Mining Phase 1. With his knowledge of geology, mining and finance, he helps his readers profit from the upcoming mining boom in which net zero plays quite a role. James and I first met while giving investment presentations in Melbourne, Australia. It was our job to give our number 1 investment thesis to the rest of the publishing company that we both work for. And we gave an extraordinarily similar presentation about net zero, focusing on much the same arguments. Unfortunately for me, James got to go first that day, stealing my thunder. But I've got to admit, James's presentation featured a moment that made me very jealous indeed, as you'll see when we get going. He also dug into the solution to the challenge of net zero in more depth than me. But let's just say we kick off with a kick in the guts of the energy transition. A few weeks ago, a new colleague of mine gave a presentation about net zero to our editorial team. I've never seen a chart have quite such an impact on an audience before. There was literally an audible gasp and some nervous laughter. I'm joined, of course, now by that new colleague of mine, James Cooper, and we're going to be discussing net zero. But James, rather than breaking this to people gently, I want you to take us through that chart. It's actually 2 charts. It's the second one that drew that audible gasp. Take us through, it speaks for itself almost, but take us through what these 2 charts show.
Yeah, well, first up, thanks, Nick, for having me here. First up, we've got the global primary energy consumption chart. So this just shows all the energy consumption across all our different options that we have available. So we've got renewables at the top there, so the green little sliver. We've got the nuclear, which is the yellow. Then we've got all the fossil fuel options, so gas, oil, coal. And that makes up 82% of our total sort of energy supply. Then we've got biomass there at the very bottom. So if we take all those traditional forms of energy out from that equation, we're left with that huge supply gap, so filling the void. So I've done a sort of rudimentary sort of editing and just cut out all the sort of fossil fuels. And it really does demonstrate the sort of insurmountable challenge that we have in sort of replacing all these fossil fuels. And that we just have a tiny sort of portion of renewables at the top there. So it's a gigantic task. And I think you're right. This graph sort of really emphasizes that problem that we have.
Yeah, it puts everything into perspective, and it's ironic how much we hear about the little sliver up the top and biomass almost as much down the bottom there. It's worth mentioning on this chart, there's carbon capture and storage there. So fossil fuels, but the carbon that they emit is captured and stored. And so the big question becomes, how much can we capture carbon efficiently, effectively, cheap enough, and so on and so forth. And to that extent, we might be able to have some fossil fuels. But of course, carbon capture and storage is very energy intensive, which means the whole energy challenge gets even worse. Right, with that extraordinary chart out the way. James, let's quickly mention who you are, what you do, why you gave such a similar presentation to me at our editorial meeting. If this is a case of great minds think alike, then we must be smart.
Yeah, sure. Thanks, Nick. So I just started with Fat Tail, the investment advisory platform in Australia. So I launched Diggers and Drillers. So we have a mining focused publication. So that's just using my previous experience as a geologist, predominantly exploration. So we're really sort of tapping into the opportunities, which does go into the critical metals space, so net zero challenge. Also looking at other opportunities, so uh, different energy forms of energy, which may not be sort of so mainstream, and just more traditional commodities as well. So like gold, iron ore, these sorts of things. So really just looking at the full spectrum of opportunities and just using that industry knowledge to sort of pick these stocks, but also looking at the macro picture as well.
Yeah, and that's why I've invited you on. Our roles are very similar. We try and turn these big ideas into actual, specific, practical financial advice, which will not feature in this video. But the idea is that we can explore where you're looking for stocks, what sort of exposure you're looking for given the net zero story. And you come up with many of the same conclusions that I do. But first of all, let's go through the net zero challenge. You started your presentation with the missing piece, as I think of it, which is just how bad the fossil fuel situation is because of the vast amount of underinvestment. Now, a few days ago, Nigel Farage interviewed someone from the Green Lobby, shall I say, and this person from the Green Lobby was saying this energy crisis is a fossil fuel crisis. It's just another example of why we shouldn't rely on renewable energy. And of course, the question is, well, why is there a fossil fuel crisis? And your presentation explained the connection to net zero.
That's right. So it really does start with fossil fuels. So um, I remember back in the presentation I did with you guys a few weeks ago, I mentioned how oil and gas discoveries in 2021 hit their lowest levels in 75 years. And that was according to one of the big sort of energy analyst firms, Rystad Energy. So why does that really matter? Well, 75 years ago, so we go back to 1946, and energy consumption back then was just 100 exajoules. But bring step forward to 2021, and annual energy consumption is almost 600 exajoules. So same rate of discovery from 75 years ago, but six times the demand. So it's that's sort of the challenge that really awaits. And this problem really started back in 2015. So this was at the bottom of the commodity downturn. So the very sort of the most metals, oil and gas really sort of hit their low point in 2015, 2016. But the problem for oil and gas investment at that time hit multi-decade lows, and Rystad Energy rightly pointed that out to the global economy, that they were one of the few really sort of pinpointing this looming problem. But that problem hasn't been fixed, so it's really fallen on deaf ears. So over the last sort of 6 years, this multi-decade low in new discovery and new investment in oil and gas has really just hit new all-time lows. So rather than sort of rectify that problem, it's just becoming worse. And I think this is also highly inflationary because we've potentially got shortages of energy, which is being led by a lack of new oil and gas discovery. So really presents us with a problem. And I think governments are assuming that the sort of renewables will sort of pick up the slack from declining oil and gas discovery. But but this is a much more immediate problem than I think most people give weight to, because to bring an oil and gas discovery into production can sort of take up to 10 years. So it's it's looming as an immediate problem because this all started back in 2015. So we can really use some simple maths and say, okay, maybe mid 20s, that's when the shortages of fossil fuels really starts to hit. But then we get to the problem, can we actually generate enough replacement technology, so wind farms and solar panels, when this oil and gas sort of cliff starts to sort of hit the global energy market? And that's where we could start to talk about whether we could get to that point.
And so to sum that up, it seems like we've transitioned away from fossil fuels before having this alternative up and ready, to the extent that it's even possible to have it up and ready. So you're expecting there to be a sort of quite a long, consistent period of energy crises. And the last year, 2 years in Europe, is going to be the norm, not the exception.
Yeah, that's right. I think I mean a lot of people have spoken about Europe as it really had to get out a free jail card. It was looking problematic, but then we had one of the warmest, or Europeans had one of the warmest winters on record. Also did a great job of looking for alternative supplies. I know Australia supplied gas to Europe. So it really averted the crisis and probably masked some of the looming shortages. So one of the largest or the largest oil and gas producer, Aramco, stated that the world is currently running on around 2% excess capacity. So it really doesn't take much much of a spike in demand to really kind of change the dynamics of how we sort of manage our energy needs.
One of the big takeaways here is that if people expect the net zero attempt to fail, and if they believe that we'll just transition back to fossil fuels and that'll fix the problem, they're in for a really rude shock and an expensive shock.
That's right. And I think if we sort of look at the critical metals, so um, I know you had a, a professor, so Associate Professor Simon Michaud, on one of your podcasts recently, and he's one of the few people that has really kind of dug into the data and really tried to determine, do we have enough metal sitting in the ground to to sort of reach this net zero goals. So he's one of these people that have looked at the total metal reserve sitting in the ground versus what we need to replace one generation, or what we need to entirely replace fossil fuels with one generation of wind farms and solar panels, and really comes up with some pretty startling figures. And I think uh, this sort of peer-reviewed study was really sort of sending shockwaves through the EU and through sort of political leaders have just assumed that these critical metals, the renewables, would just naturally pick up the slack from lack of new oil and gas supply coming through. So just to, I guess, highlight some of the dramatic data that he found, which has been critically reviewed among academics. So the data does stack up. It's strong. So based on current annual production, so current mining production, he came up with around 9,900 years worth of lithium and 1,700 years worth of cobalt, 3,200 years worth of graphite. So it's just these figures that really sort of put a dent in how we can actually achieve this net zero.
Yeah, and there's been a few similar studies by people other than Simon that have found similar. Obviously, it depends on how you play around with the assumptions. But one of the key issues that you especially know about is that much like in the fossil fuel energy world, investing in mining and the status of the mining industry isn't particularly healthy either. This is only partly due to the net zero story, although it is becoming more difficult to permit and develop a mine. But take us through what the state of the mining industry is and whether it's going to be capable of delivering, in your view, the amount of metals and other resources needed to try and fill that void as we started off with in the transition.
Yeah, so the problem with mining is we've really gone through the same issues that the oil and gas industry has faced. So that's just a lack of investment in the industry. So around 2015, 2016, we saw a major low in the industry. So it's this same problem of lack of investment, which is really going to translate into lack of supply over the next 5, 6 years, or probably earlier. So it is picking up, especially in Australia. There's more funding going back into exploration, but we've had this enormous gap in new discovery, which is really going to translate into problematic supply in global chains over the next few years. And I'm not sure if you can see this graph, Nick. So it just shows you copper discovery over the last 10 years, and you can see it really is at record lows. If we go back to the 90s, copper discovery, we were making sort of 10 to 15 new major discoveries every single year. Over the last 10 years, we've really only made two major discoveries. So
Why
the
is that? What's changed?
yeah, so really down to two factors. The first one is what I was saying. So lack of capital coming into the industry, lack of spending on exploration. So that's from investors. It's also from the big miners themselves, not really taking the high risk bet on exploration to bring new discovery. The other one is it is becoming harder to find new deposits. So it's new deposits are deeper. All the easy sort of near surface uh, copper deposits or nickel deposits have already been found. So it's these two problems which are really kind of combining into the perfect storm. So one of the last major copper discoveries was Ivanhoe's deposit in the Congo of the DRC. So other than that, we're really sort of scrambling to sort of find where can we make these new discoveries, and that's really being made worse by the fact that in some of the major copper producing nations like Chile, we're seeing sort of increased risk of nationalization. In Peru, there's riots, there's talk of civil war. So these two places make up around 25% of total copper output. So that just puts an enormous pressure on future supply. And then we've got the third biggest copper producing nation in the Congo, which has also got similar sort of geopolitical risks. So there's a lot of factors which really not just threaten the outlook for reaching net zero, but perhaps even threatening the outlook of just maintaining our current sort of needs for copper, let alone the exponential demand that's been forecast.
One of the little light bulb moments that I had during your presentation was that just as it takes 10 to 15 years to get a mine up and running, the existing set of mines, regardless of the investment environment, they persist in their production for a long time until suddenly they shut off, which means this problem is masked by those existing mines and their high levels of production until all of a sudden it's not. So, what's the outlook for the big copper mines around the world basically running out of resources in the next few years?
Yeah, absolutely. So we can really start to see some clues. So in Chile, Chile just recently reported about a 6% decline in its output, and it attributed that to poor grades. So I've got a chart here again. So we've got global copper grades, which have steadily fallen off from about 1.4% down to a low of 0.6%. So that's an enormous drop in grade. So if you think about grade, if it's dropping off, that just makes it more expensive to mine. So for the same ton of ore that you pull out of the ground, you're going to be getting only sort of a third of the copper from that single ton of ore. So it produces more emissions. It costs more. So it costs more in fuel. It costs more in labor. So it just compounds the problem. But again, I think you can really look at these big porphyry copper deposits in Chile and Peru as an early sign to some of the threats to supply. So if we're seeing Codelco, which is the major sort of copper conglomerate in Chile, which is reporting sort of year on year declines in its output. Well, that's an early warning sign. Um, Declining output thanks to lowering grades is really an early sign of terminal decline because if it's operational, if it's weather, that's a sort of short term event. But if it's declining grades, that's not something you can fix. You can only fix that through discovery, and that has um, I've already sort of touched on that problem because we haven't been looking for these new deposits.
Yeah, so it's a perfect storm of existing supply sort of dropping off and a lack of investment. And both of those are delayed effects, and that delay is hitting now. Something you mentioned earlier about Simon Michaud's research, it only takes into account the first generation of renewables, meaning that by the time 2050 hits, we're going to have to do it all again, which, doubles, depending on the recycling rates, doubles the demand for all these resources all over again. Um, One of the biggest lessons I've learned from you, which I didn't think of before listening to your presentation at all, is the idea that it takes 10 to 15 years to get a mine up and running, but it takes 5 to 10 years to get an oil or a gas well up and running. And we've already got the infrastructure to use oil and gas, whereas we haven't got, we have to build the windmills, we have to build the solar plants, and so on and so forth, which means in a situation where we don't have sufficient energy to run our economies and our societies, which is what you and I expect because of this lack of investment, if we get a desperate scramble for more energy, all the focus is going to be going towards gas and oil, right? Because it's going to be the fastest plausible solution. People won't want to wait 10 to 15 years to get the mine up and running, and then a few more years to get the manufacturing of the renewable resources, and so on and so forth. So the sort of snapback of the rubber band is going to go towards fossil fuels far more so than renewables as these energy shortages hit, right?
Yeah, absolutely. So it is the natural sort of path. I think political leaders will sort of, and the public will start to realize, okay, we're probably not going to achieve this net zero target based on making windmills and solar panels. It for a start, it probably is not enough to create baseload power, but we really have the underlying problem of critical metal supply. So you're right. I think we have some other options for baseload power. There's talk of geothermal, um, fission. So all these technologies which could perhaps one day supply the global energy needs, but it's still very in the lab research R&D type level. So it's not an immediate problem, an immediate fix to the looming problem. So you're right. I think oil and gas will be the solution until we can come up with a sort of a viable baseload power source which doesn't emit carbon dioxide.
We saw this play out in Germany, especially where when they had this issue with the Russian gas, they didn't build lots of windmills and solar power plants. They built LNG import terminals because they understood that that is the fastest way to bring in energy quickly. So if you're expecting an energy shortfall over the next few years, that's where economies will turn to. Let's turn to the solution here, which was really the theme of your presentation, and that's nuclear power, something I agree with. So give us your take on why nuclear is the ultimate solution and possibly the best investment opportunity here.
Yeah, so I think as investors start to really realize the insurmountable challenge of reaching net zero, I think nuclear really stands out as one of the most viable solution, really. In that earlier graph that I showed you, nuclear still only makes up a tiny slither of overall energy needs. There's still a lot of fear, still a reluctance in sort of bringing on nuclear energy. But I think if we are serious about reaching net zero, I think nuclear is really the only option that can provide base load power to fuel economies. There's also the potential for nuclear to produce or to help with the hydrogen manufacture, which is also really energy inefficient because it takes a lot of energy to separate into hydrogen. So nuclear as a cheap form of energy, once you've got the infrastructure in place, allows you to make hydrogen. So that sort of takes away from the need to rely on EVs, which are metal intensive. So that takes away that problem as well. Um, the problem, though, with nuclear is it does take a long time to build these giant facilities. So up to sort of 10, 15 years, maybe even 20 years, these giant nuclear facilities. So it doesn't solve the immediate problem, and I think we still need the oil and gas to come back into the energy mix through new investment in exploration and development of new oil and gas fields. So I think nuclear stands up as a sort of more longer term solution, unless we can come up with, say, geothermal, which essentially is like natural nuclear energy anyway. It's using hot rocks in the ground. Um, it's nuclear is a proven technology, so we know how it works. It's been in we've had nuclear plants, phase three plants in operation for decades. So it is a viable solution. So as an investment theme, obviously you have to sort of look at the commodity. So that's uranium. So you could look at uranium stocks. You could focus on existing producers. There's a few. There's not a lot of existing producers because uranium has been through this long bear market since the Fukushima disaster. Uranium prices really fell away. We've only just seen a recovery start to happen in uranium prices since about 2020. And that just means there's not a lot of explorers to choose from at the moment. So you really have to just look at some of the big major producers. There's some in North America. There's a few options in Australia. And there's a few developers looking to sort of bring back their uranium mines that have been sitting on care and maintenance for the last sort of 10 years while your uranium prices have been depressed. So um, it perhaps doesn't offer the same diversity of opportunities like you would see in the sort of net zero EV battery metal landscape because it is purely just uranium. Unless maybe you looked at some of the sort of technologies that will feed into building some of these nuclear power plants as well.
Yeah, a lot of the government control in this sector is quite stifling. Let's turn to the other two investment themes that you can generate out of the net zero story. So number three is nuclear. I've got number one and two is the resources that will be in shortfall in the attempt to reach net zero. So the resources that are connected to the renewable energy side of things. And then the idea of fossil fuels that will snap back towards. Take us through where you're looking within both of those two fields.
I think the net zero attempt, so it's going to still be a very strong theme. I think that's still going to be in place for a few years yet. So we recently added some lithium stocks, which kind of went against what I was thinking back in 2022 when lithium was skyrocketing to all-time new highs. But then we had a huge drop in lithium prices to around 70%. So lithium carbonate fell to a new low in around April. So that's when we started to look at lithium, having sort of really shut the door on that theme for a while because it was very heated. It was very sort of speculative. So I think there's still opportunities for lithium. The recovery looks like it's underway. Of course, there's copper as well. So focusing on copper stocks, explorers, developers is probably your best bet if we're looking at some of the major producers. Well, a lot of these companies are operating in some of these countries that are having problems like Chile and Peru and the Congo. So it gets difficult to it adds to that risk that maybe some of these mines could be nationalized in Chile, something that they just did with lithium in the last few months. So
And of course,
that
James, you would expect that those sorts of political pressures are only going to grow as Western governments try to impose the net zero challenge on poorer countries because it means less energy is available for them, which means lower living standards. So there's a little vicious cycle there.
exactly, and mine nationalization. So that's when the country, the state, basically takes control of the mine from the multinational operators who own them. Funnily enough, it always happens when commodity prices are starting to go up. It's usually a good friendly relationship, but then commodity prices go up, and that's when nationalization tends to happen. So if we're bullish on copper, that's going to be a growing threat in places like Chile. So it's something to consider. So that means looking more at the smaller end, so explorers, developers. We have a few options in Australia. Um, we don't have a lot in terms of pure copper plays. So obviously, if you want to leverage off this sort of emerging trend, you want to have pure exposure to copper rather than a diversified explorer. Now there are a few that are listed in Australia. There's also a few in Argentina. Um, Perhaps a little bit more risk there than Australia, but still, it's across the border from Chile, so I don't consider it the same as risky as Chile or Peru. There's some great geological deposits which follow that same porphyry system. Porphyries are the big giant copper deposits that you find in South America. So it follows that same Chilean geological system with the advantage of just being across the border in Argentina.
And what about the fossil fuel side of things? Where are you looking? Because, for example, I'm assuming that coal mines take a very long time to approve and go through that development process as well. So, although it's a fossil fuel, the fast route goes to gas and oil in a slightly less related way.
Yeah, coal's a difficult one just with the regulatory hurdles. That may get easier as governments sort of scramble for back to fossil fuels with the sort of looming shortage. Oil and gas, I think there's more diversity of opportunities. Um, if you were just looking at it more broadly, I would be probably more focused on the North American market because there are so many opportunities, and just focusing on a sort of an explorer slash producer ETF that focuses on oil and gas. Um, as well as that, I would be focusing on the service side. So we've got companies like Halliburton, which supply the oil and gas industry. They also assist with exploration in oil and gas. So these Halliburton, which have been uh, revenues have been pretty suffering over the last sort of several years with investment coming away from that industry. But I think with this sort of looming shortage, there's real opportunities to sort of get back into the oil and gas service companies.
Yeah, that seems like a great idea. It's the old, sell the shovels rather than going digging because you might not find the gold. Um, why are you focusing so much on the explorers and developers? Is it because you want them to sort of have the proven deposit in the future when prices are higher? Or is it because a higher gas, oil, coal, whatever it is, price means that the chances of finding a viable deposit have gone up because your marginal deposits are economic at higher prices? So where's the rationale behind it?
Not necessarily just explorers, but I think if you're going to look at oil and gas, I'd be focusing on either explorers or developers or producers that have um, a long supply of several years supply of oil and gas. Because the problem is with this lack of new investment, a lot of these existing producers do have aging oil fields. So that's the risk. They've been paying out big dividends, but they haven't been putting money back into development. So that there is a risk there that they may sort of start to see declining output, which will have an effect on margins. So obviously exploration is kind of more your speculative um, way to play a sort of rising oil and gas prices. If you're not willing to go down that route, I'll be looking at a producer that has a known large oil field that has several years, if not decades, of supply ahead of it.
Yeah, perhaps it depends on people's individual situation and their risk appetite. Is there any part of this that you would recommend avoiding, such as a particular resource that you think is not going to be needed, or something that's already gone up too much, like lithium had until it crashed back down again? Perhaps a particular type of energy that you think is not going to make it in the energy transition?
Yeah, I think if we're sort of thinking more broadly as a commodity-wide boom, so one of the big themes that's pushing that is the net zero. Also, oil and gas is going to come into the field. Um, but we can kind of really look at all commodities, even things like iron ore. Um, Possible stimulus from China could push up iron ore prices. Um, but within a commodity-wide boom, there's cycles within cycles. So you have some commodities performing well, and then they'll decline, and on the back of that, you'll have other commodities performing well. Um, so it is really sort of trying to capitalize on weakness in specific commodities during this overall bullish turn for the commodity sector. And that's, say, what we did with lithium was to focus on a pullback in that market and capitalize on that. So the biggest risk, I think, is buying a commodity which is sort of making new all-time highs. So that's what we saw with lithium late last year. So if you were following that trend, you would be sort of sitting on some pretty hefty losses now from sort of November 2022 when lithium prices peaked. So yeah, just following the commodities which still have this long-term strength, but then capitalizing on weakness in the market.
Are you worried about the damage that attempting to reach net zero is going to do on the wider economy, the rest of the economy, and therefore the demand for those resources? Because of course, net zero is not the only source of demand for things like copper.
Yeah, I mean, there's others that are more sort of versed in the sort of geopolitical threats that come from lack of commodities. I know it's responsible for major conflicts and wars. We've got geopolitical tensions between China and the West, and a lot of that could be attributed to commodities. China has been
Yeah, but I'm thinking more about what's going on right now, where the economies around the world are slowing, and therefore the copper price is going down, despite what you and I have been talking about, and presumably attempting to achieve net zero is going to cause a very severe economic hit to GDP, and that comes with falling commodity demand, right?
yes. It's whether you look at those short-term pressures, so rising interest rates, and I mean, we've got past the debt ceiling in the US. It's whether you think those short-term factors are fully priced in, So copper hasn't really performed in 2023. It's gone lower. So has this weakness in sort of global equities, has that really now fully been priced into commodities? Um, and I think investor sentiment seems to swing from the short-term risk to then all of a sudden going back to the long-term bullish trend, which is more copper is needed for this green energy transition. And I think we'll start to see that soon because we've already had weakness or weak data from China filter through. Um, I think the effects of rising interest rates have probably fully fully affected the prices of things like copper. So it's difficult to see where the next price weakness could come from. I think the more probable uh, impact is going to be the long-term bullish outlook for copper. So I think you will probably start to see investor sentiment start to swing back to that longer term picture.
I still want to give a bit of a risk warning here because for those of you at home who think we're going to go for broke on net zero and the politicians are willing to destroy the economy and living standards in order to try and get to net zero, it's probably not so good for copper demand. It's probably better for copper demand than any other investment out there, but it's probably still not so good. For those of you who expect politicians to abandon the net zero campaign, but still have a significant amount of renewable energy, then it's still probably a good story. My last question, which I'm hoping you can answer better than anyone I know, is about these metals that are mined as a sort of secondary source as part of a different metal. So when you're mining copper, a whole bunch of other stuff comes out of the ground as well. That a lot of rare earth type metals that are needed for the renewable energy transition. And one of the interesting stories for me at the moment is that the price of those metals, those rare metals that are mined as a byproduct, they don't really determine the supply because the supply is a function of the copper price or of the nickel price. And these secondary resources, therefore, could spike in price and become extremely rare and in short supply without more supply coming online to try and replace that because there's lots of regulations and constraints on mining for copper and nickel and these more common metals. Do you see this phenomenon playing out? And is there any obvious solution to it? So, is someone going to figure out a way to mine for indium or neodymium or whatever it is, these metals that are currently mined as byproducts of other major, more commonly understood and known resources?
Yeah, so I'll try and uh, tap into the question. So if you've got certain deposits, so say what's known as ISCG deposits, these are sort of like multi commodity deposits. So they contain iron ore, they contain gold, uranium, copper. That's what Olympic Dam in BHP in South Australia. So there is the potential there for boosting, I guess, some of the sort of critical metals, um, especially when we start to look at gold, because a lot of gold deposits actually have copper credits. Um, that could actually add to the mix with more copper. There's a lot of copper gold deposits. That's quite common in North America, also in Australia. So yeah, byproducts from existing mines could be a solution to sort of pick up some of the shortfalls, but I don't think it's going to really make a tangible impact on the enormous supply that we need for these niche metals. Um, Cobalt's another one where you often see as a byproduct from things like nickel mines. Um, yeah, it's an interesting question. It depends on the geology. Different geological deposits tend to have sort of multi-commodity deposits that they do add complexities to refining and processing. Often the mining, the miner will report as sort of gold equivalent or copper equivalent, so it will focus on its principal metal type. So if it's mostly mining copper, this these byproducts sort of get weighed into sort of a copper equivalent product. Um, yeah, so I'm not sure if that really answers your question.
I'd love to find, a mine that is focused on resources that are usually byproducts of other mines because of that supply inelasticity. So if the price of these rare byproducts quadruples, that still doesn't justify a new copper mine that mines as a byproduct these strategic metals. So if there was a way to just focus on these strategic specific metals, a particular mine or a recycling process or something like that, I think that would be the best possible way to profit from the green energy transition, because these mines are going to be sort of getting less and less and the investments falling, which is going to cause supply shortages in places that we don't expect them. Anyway, James, thanks very much for helping us turn net zero into a whole bunch of investment themes and opportunities. I hope it helps people find ways that they want to profit from the attempt at net zero and what we think is going to be the failure of it.
It's a pleasure, Nick. Thanks for having me on.
And everyone at home, thanks for watching.